In continuing our topic of treasury stock, now we'll be focusing on the resale of treasury stock to outsiders. Now, to do so, we'll be pretending that we already booked previously the repurchase of 1,000 shares, our own shares, buying them back at 10. So that's our cost per share. In total, we spent $10,000 to repurchase our stock. At that point in time, as you may remember from a different lesson, we debit treasury stock for $10,000, which would go there, and then we're going to credit cash. Now, so in the posting of the treasury stock account, we would then see $10,000 here reflected. Okay, so given that, now we have three scenarios in sequence. We're going to be selling 300 shares at $10 per share. So $10 price, our cost is $10, so we'll be selling at cost. That's what this means. So our two-way scenario is selling treasury stock at cost. 2B is where we sell shares or treasury shares at a price that is higher than our cost, 12 versus 10. So 2B here, that's what it says, sale of treasury stock above cost, and 2C would be sale below cost. That's what this is, because we're going to be selling 200 shares at 8, which is below our cost. So how does that get reflected in the journal entries here? So let's do it. Quickly, hold on. So in 2A, again, we're selling 300 shares of the 1,000 we previously purchased for 10. So 300 shares times 10, we're getting from the buyer $3,000. So cash will be debited for $3,000. The treasury stock account would be then credited for the same amount. And in posting that, we would actually see $3,000 here for that sale, leaving us with a balance in the treasury stock account of $7,000 after that initial sale. Notice that here I'm actually also crossing out the PAC in excess of treasury stock because there's no excess. The excess really always relates to the sale price versus the par value. In this case, actually, will be the sales price versus the cost. It's the same, so there's no excess. So there's no need for that account. All right. Now that takes care of 2A. How about 2B? In 2B, we're looking at 500 shares being sold at a price of 12. Well, in that case, there is an excess. You have $12 price, which is above 10, our cost. So there's an excess of 2. Well, in terms of the cash, how much is that? Well, 500 shares times 12, that's the price, would mean we're going to get cash of $6,000. In terms of what gets booked into the treasury stock account, that's always the number of shares at cost. No matter which one you're looking at in terms of scenario, it's always number of shares sold at cost. Well, we're selling 500 shares. Our cost was 10. So 500 shares times 10, that's $5,000. So when you relieve treasury stock, you're going to see, in this case, $5,000 being credited to that account. And the PAC account will be the difference between the price of 12 and the cost of 10. So $2 times 500 shares, that gives you $1,000. So then that will be that kind of credit, $1,000. When you post those into the ledger accounts, you would see $5,000 being reduced from the treasury stock account, leaving a balance of $2,000. Here, since there was some excess, we would be then posting this $1,000 as excess into the paid-in capital in excess of treasury stock account. So that increased equity, as you can see. The last one here is 2C, which is 200 shares. That's what remains at $8. So that's below cost. And so in that case, we're still going to book cash, a debit to cash, for the amount that we're going to be receiving. 200 shares times $8 is the price, $1,600. So we're going to have cash at $1,600. The treasury stock account, as I said before, is number of shares always relieved at cost. So that cost is 10. 200 times 10 would give us a total of $2,000. So that will be how much is credited for the treasury stock account. And then the PIC, in this case, will be debited. See how when we have an excess, we're going to be reflecting that as a credit. If we have a deficiency, such as in this case, $2 difference between the $8 price and the cost of 10, that's a debit to the PIC in next account. So as you can imagine, $200 times 2, that will be $400 that we debit that by. So when we do the actual postings here, when we debit that $2,000 to treasury stock, you would see that that would actually then finally eliminate the balance for treasury stock. When we post that debit to the PIC excess treasury stock, we would end up with a ending balance for PIC excess treasury stock of $600. With respect to the equity section, you would then see treasury stock here. This way there's nothing left, so there will be 0 in that case, so there will be no effect. But we would definitely have here a PIC treasury stock. In fact, this will be not a negative actually, of $600. So this will actually increase equity by 600 because we actually got more than our cost once we resold it.